This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through the business news stories you need to know about from the continent and beyond. Let's start with a run through the markets for you though. So far, October has been pretty positive for some of the markets that we track here. The all share in the top 40 of the JSE, nearly 2% and 1.2% high so far this month. Nigeria's main index though, that has risen by the highest margin, up nearly 7%. In a month that has seen protesters demanding police reform and an end to police brutality in Africa's largest oil producer. But will those gains continue through to the end of the month? We'll find out. Here's what's coming up next. Ghana enters an agreement with Egypt Air on efforts to relaunch its national carrier. Zimbabwe's Victoria Falls Stock Exchange is formally launched. And we'll take a look at the details of the post-Brexit deal the UK has signed with Japan. But let's start in the world of aviation at this hour. Egypt Air and Ghana's government have signed a memorandum of understanding to launch what they're describing as a strategic partnership with the aim of establishing an integrated Ghanaian airline through joint investments from both parties. Now, the MOU that was signed today aims to enable the Ghanaian side to benefit from Egypt Air experience as one of Africa's oldest airlines, providing services to more than 80 destinations around the world. The deal is also being described as an achievement for Egyptian aviation in the continent as well. It's being described as a turning point on the road to Egypt's cooperation with Ghana in particular. All right, then, so let's dig into the details of this particular story. CGTN's Nabil Ahmed Rufai joins us from Accra. Adele Makruki is in Cairo as well. Adele, let's start with you. So Egypt Air reported some fairly solid numbers for the 2018-2019 fiscal year. Profits in its maintenance and engineering and cargo sections were fairly solid. But what is it bringing to the table as part of this deal?
So Egypt Air in general, yes, it has amassed about 100 million US dollars in profits in the 2018-2019 fiscal year. But let's not forget that this year has been quite harsh on the Egyptian national carrier. It has lost so far an estimated 191 million US dollars. That's so far and until the regular flights and the full services in the flight and the cargo and the maintenance are resumed back to normal. This will keep on going. Now the partnership basically comes, as you briefly mentioned, to establish a flag carrier for Ghana through which Egypt Air aims to be a partner is, whether that's include also expertise giving maintenance services or even being an investor as part of that new flag carrier. Egypt believes that it is part of its expansion plans in general, and for it is a crucial step to step in deeper into the African continent.
Indeed. Nabil, we know that Ghana's government intends, at least as we knew earlier, to own just 10% of the re-established national carrier. But given this deal that we're seeing now with Egypt Air, how is that going to be structured?
Well, Rama, this new deal with Egypt Air, as we know, was just signed today, and details of this deal are quite scanty at the moment. But we know that the aviation minister has said he's preparing to submit the deal to Parliament for approval. And when it gets to Parliament, we are going to know the details of this particular deal that Ghana has signed with Egypt Air. But we know that in terms of the structure, Egypt Air is likely to provide managerial support for the airlines, and also there is a possibility that Egypt Air will lease the planes to Ghana in the short term, and then in the long term, we are looking at the fact that Ghanaians will begin to take control of the home-based carrier in terms of those who will be flying the planes and the cabin crew. So for now, we know that this is what is going to happen, but it's good to also point out that Ghana was in talks with Ethiopian Airlines for this particular deal, but then at the last minute, it has signed a deal with Egypt Air. The aviation minister has said that they decided to settle on Egypt Air because they believe they are getting a better deal in terms of funding for the airline, and also the fact that the fleets are going to be increased, and the tenure of the management of the contract is quite better as compared to what Ethiopian Airlines was, proposing to the Ghanaian government. So this is what we know for now, Rama.
Indeed. Adele, how does this fit into Egypt's wider plans? Is there a wider push coming in from to try and turn Cairo into a hub for passenger and cargo traffic coming into West Africa, particularly from Asia?
Egypt has been trying to move in that policy for so long, but it has not been so fortunate. The reason for that are quite numerous. The attractiveness that other countries' major hubs like the UAE, for example, comes when it comes to travel into and out of Africa. Ethiopia as well has been quite an attractive spot in that regard. But getting into Ghana through the flag carrier is sort of a great exposure for the national Egyptian carrier to get from the African continent. It will be operating flights within Africa and even to Latin America as well from Ghana. And as Nabil was saying, the Egyptian pilots are expected to be taking over at least for the coming short or medium term until there is caliber from Ghana to become main pilots or lead pilots, and that is the time that Egypt really needs, Egypt Air specifically, to lift off great pressure financially. Salaries in general has been the biggest challenge for Egypt Air during the COVID-19, and this has made the company start to look for other alternatives. Now with this partnership still an MOU, there's still a long way ahead, but still it gives an opportunity for Egyptian pilots to get busy with their jobs and have other opportunities still under the umbrella of Egypt Air. So it's basically a win-win for the national Egyptian carrier here, Ramah.
One last question for you, Nabil. Ghana had ordered a couple of aircraft, at least 4 of them, I believe, from Boeing, 787.9 Dreamliners, just last year in November, with a view to starting operations this year. Obviously, COVID-19 came along and messed things up, but how has that changed the plans to launch this airline?
Indeed, Rama, well, there's not been any much progress in that regard since Ghana planned to buy those 3 aircrafts at a cost of $877 million. COVID-19 has hit, and of course, what the government is concentrating now is how to make the economy bounce back. So there's not been any much talk about whether the government is going ahead to buy those 3 aircrafts or what plans they have for this particular deal. But, well, all attention is on recovering the economy, and the aviation minister has not really come out to say if we are going ahead with this particular deal in buying these aircrafts at the moment. So it's uncertain at the moment if these particular aircrafts will be bought, but there are some indications that some people who have been skeptics of this whole deal in the first place were saying that they feel because Ghana is going to the polls in December, the move to buy these aircrafts was actually a political statement and not really the government wanted to buy it. But then the government on its defense has said it's really committed to creating this national home-based carrier because Ghana has been without an airline for since 2010, and it's good that we have our own airline. So we can only wait and see if the government will still go ahead to buy these 3 airplanes from Boeing.
Indeed. We'll leave it there for the time being. Nabil Ahmed Rufai in Accra in Ghana, and of course Adel Makhrouki in Cairo. Thank you, gentlemen. Now, let's get into the world of sovereign debt. Africa's second largest copper producer now just has about 21 days left to make a scheduled payment on its 2024 Eurobond. Zambia missed that payment that was originally due on the 15th of October. There's a 30-day grace period somewhere in between there, and it's asked creditors for a 6-month debt service break. Now, such a break could affect $120 million worth of payments, but a group of creditors holding about 40% of Zambia's Eurobonds abstained from voting on that proposed standstill this week. That vote will now take place on the 13th of November. The Eurobond holders have 3 main issues. First, debt transparency. who do you owe money and at how much? Second, equal treatment of all creditors, including bilateral lenders. And third, they also want Zambia to get on an IMF program as part of any debt restructuring deal that's eventually agreed to. But is it possible to have all of that done in just 3 weeks? I put that question to Mark Boland. He's a senior analyst at Red Intelligence.
I don't think you really need to get all that in place, but of course you need kind of the rough framework of how you're going to arrange this, and I don't think that is achievable within this time frame. So that's quite clear. But I mean, what the government is hoping is to have a debt restructuring agreement in place by, I think, April or Q2 next year, and then also get an IMF agreement, ideally with a bit of financial support to help him to tackle the COVID-19 crisis and the general economic crisis. But I think that's a very optimistic timeline.
The fact of the matter is, though, I mean, Zambia and the IMF have been talking since 2016, and they've not agreed to any kind of support program, policy program, and the IMF has been fairly consistent in warning about their debt service problems. I mean, why should the IMF now agree to a deal with the country, yet for the last 4 years, there's been no agreement?
Well, as you know, the IMF has been quite quick at rolling out financial support for I mean, the majority of countries in Africa, and this has been, essentially, well, it has been unconditional support. I mean, there have been, well, not entirely unconditional, but I mean, it has been money they pumped out to help these countries to use them to counter the pandemic, the global pandemic. So, but it hasn't been the kind of other conditionality when it comes to sort of more extensive conditionality that you would have for the normal IMF programs. So I mean, that's what the Zambian government hopes to secure, ideally before the elections in August next year. But I do think this is conditional on having maybe not all the details nailed down, but at least kind of a framework agreement for the restructuring of debt. And I don't think that is going to be achievable.
And this does pose an interesting catch-22 for the IMF, doesn't it? Because on one hand, if it does provide some sort of support before August, or even before April next year, which is when this 6-month debt standstill window does close, it would essentially be seen as rewarding negative behavior, wouldn't it?
Well, I think, yeah, I'm not sure I would put it exactly like that, but I think, I mean, the IMF they had a policy paper out a couple of weeks ago about debt restructuring, how they're going to deal with future debt restructuring, or their recommendations, how they're going to deal with this ahead of the G20 meeting. And essentially what they said is that they want to deal with debt restructuring issues early. They don't want to have this kind of drawn out process lasting several years, as you had ahead of the multilateral debt relief in the early 2000s and also with previous cases in Latin America. So what they're aiming for, they want to get a deal quickly, deal with the debt as quickly as possible, and have a real effective cut down, restructuring in the debt, or reduction in the debt, to help these countries get back up on their feet. But I think that will also be dependent on having a counterparty which they feel they can work with and they feel are reliable and will actually implement the policies that they put forward to the IMF. And I think that's going to be difficult both with the present Zambian administration and then the one you're going to have after the elections. I mean, I won't go into trying to predict the Zambian election result here, but I think definitely that's going to be a barrier for any agreement.
Indeed. One last question for you, Mark. So Zambia obviously is the one that we're paying attention to now, but are there other sub-Saharan Eurobond issuers that you're concerned about with respect to their ability to service their debt?
Yes, I mean, of course, we have the oil producers that are already feeling a lot of pain. The Republic of Congo started the debt restructuring operations with both China and the commercial creditors, oil traders last year, but that's currently on hold because the oil traders are not agreeing to write down the debt, which is essentially an essential part of the deal. But I think Ghana is one of the other countries I'm most concerned about at the moment, which has borrowed a lot from the Eurobond market in the last few years. In the beginning, it was initially to finance capital expenditure, infrastructure investment projects. In the last few years, it's just gone straight into the budget. And I think if you see Ghana getting locked out the Eurobond market. They were very lucky to issue early this year, but I think that's going to be difficult to do last year. They're going to have a problem with a balance of payments and also with the government finances. So that's one of my main concerns at the moment.
Now, in the 6 months ending in June, South Africa's big four banks experienced a profit slump more significant than they did during the global financial crisis. Now, this comes as they continue to grapple with the effects of the coronavirus pandemic and a nationwide lockdown. CGTN's Angela Coppola assesses the measures banks in South Africa have put in place to ride out this economic storm.
Absa, FirstRand, Nedbank and Standard Bank suffered headline earnings losses for the period, due almost entirely to credit impairments.
If you look at the income statement before the effect of credit impairments, what you find, what we call pre-provision operating profit, that is actually shown that the banks are quite resilient, and pre-provisioning operating profit has increased 4.4%. Why is that important? Because it means that from a earnings perspective, the machinery of the banks have continued to turn.
These South African banks have taken a very similar approach to protecting their bottom lines in the initial stages of the pandemic.
Firstly, it was around protecting their people, protecting the operations of the bank, and moving quite swiftly from a focus on profitability towards tilting the balance sheets for resilience. And I think those three actions together, and obviously there were a lot more underneath that, have held the banks in good stead.
The current challenge is to ensure that those impairments don't become economic risks. But there's a bigger challenge looming in the next 6 months.
So when you have an economy like we do now, with tremendous levels of uncertainty, that is probably the biggest risk facing the banks over the next 6 months. They will navigate that based on a number of measures that they've taken over the years. For example, stress testing, building up stocks of liquidity and capital to try and navigate this very uncertain period that lies ahead.
These South African banks have a long history of being prepared for any eventuality.
And that's a credit to a variety of factors: the quality of the management teams, a very prudent and robust regulatory regime in which we operate, and regulator. And so while we all find ourselves in a once-in-a-generation crisis at the moment, I think what one needs to pause and reflect on history and think that, all things being equal, this is a crisis that the four banks will navigate with resiliency, as they have other crises in the past. And so the health of the South African banking sector, in our view, remains resilient.
I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
Right, then a quick run through some company news, starting with one story that may be partially responsible for the spike you saw in Bitcoin yesterday. PayPal Holdings, it's a US-based online payments company, has joined the crypto world. The global firm, which deals with online money transfers and it serves as an electronic alternative to traditional cash, will now allow clients to buy, sell and hold Bitcoin and other cryptocurrencies using its online wallet. PayPal subscribers will use virtual cash to shop at over 26 million merchants on its network, starting in early 2021. The online streaming giant Netflix has set its sights on conquering the Kenyan market. That comes after setting up its foothold in South Africa and Nigeria, two of the largest economies in Africa. Netflix is said to be working with several telecommunications operators that will enable subscribers to pay for services through mobile money services. It's already entered into partnerships with Vodacom and South Africa's Telkom. Netflix has 193 million subscribers worldwide. In banking, Barclays has recorded stronger than expected third quarter results as its consumer business swung back into profit and bad loan provisions fell. Barclays reported profits before tax of $1.4 billion for the 3 months ending in September. That's nearly double the $663 million that analysts had forecast due to the pandemic's effects. Barclays shares jumped following its results. They were trading 4.6% higher at 7:35 GMT. However, the bank warns that the economic outlook is still getting a lot worse. And finally, the US retailer Gap could close all of its stores in the UK, putting thousands of jobs there at risk as it mulls shifting its operations to a franchise-only model in Europe. Now, Gap may close all of its shops in the UK, France, Ireland and Italy next summer, and the retailer may also close its European distribution centre in Rugby. The retailer, whose sales have been falling steeply in recent years, reported a near $1 billion loss in the 3 months to May due to the disruption caused by the coronavirus pandemic. That's a run through your headlines. You're watching Global Business Africa. Here's what's coming up next. Zimbabwe's Victoria Falls Stock Exchange is formally launched. And Tunisia will be spending nearly 10% more than planned in 2020. We'll look at the revised budget shortly.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business, only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible and why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
On to Zimbabwe now. It's launched the Victoria Falls Stock Exchange. That will be its second bourse at this point in time. Trading, depository services, clearing and settlement, however, will only start on the 26th of October. That's next week, Monday. Now, the bourse is a subsidiary of the Zimbabwe Stock Exchange. It will, however, be trading exclusively in foreign currency. From Harare, here's CGTN's Ramah Nyang with that story.
The new exchange has injected optimism into a market that has recently witnessed an exodus of foreign investors, a wave of delistings, and a shortage of IPOs. The Victoria Falls Stock Exchange, VFEX, is mainly targeting the mining industry, which accounts for just 2.5% of the Zimbabwe Stock Exchange's market capitalization.
We've got a couple of mining companies that are listed in external exchanges on the Toronto Stock Exchange, I think on the Australian Stock Exchange, and even Mauritius, that are operating out of Zim. It will be, great. It will be good. It will be exciting for them to also have a local listing on the local market, but a market that allows them to also raise the right, dollars for investment, and also a market that is able to compete with the external market.
Officials have allayed fears that the allure of hard currency earnings on VFEX could undermine the main Zimbabwe Stock Exchange.
Our feeling is that they will complement each other. So the way we think is going to happen in the long term is that ZSE becomes more for the domestic companies, and VFX is for more export-oriented companies. And also what you need to think about Victoria Falls Stock Exchange as well is that we're quite ambitious about it. It's not just for Zimbabwe, it's also for the region. So if you think of the region, is that there is no, besides Mauritius, there's no other exchange where you can raise United States dollars.
Authorities have a long-term plan to expand Victoria Falls from being just a tourist hub to an offshore financial services center, and believe setting up an exchange there can be the tip of the arrow for that strategy. They have rolled out incentives and assured investors of consistency, especially regarding currency issues.
So if you talk to foreign investors, the big thing that they talk about is that they come to Zimbabwe, but they struggle to get their money out. So if they can't get their money out, then they stop coming in. So what we need to make sure is we need to make sure that the clearing and settlement on VFX works.
Only one counter, Seedco International, will be on the board when VFX opens on Monday, but it's hoped many more will be drawn by the thundering sound of the iconic falls and follow suit. Ramah Nyang, CGTN, Harare, Zimbabwe.
On to Tunisia now. It's revised its 2020 budget upwards by nearly 10% to a total spending outlay of $19 billion. As authorities there continue to grapple with measures designed to contain the economic fallout from the COVID-19 pandemic. This budget is the largest in Tunisia's history, but there already are concerns about where this will leave the country's external debt profile. As things stand, it's already 70% of the North African nation's GDP. Here's CGTN's Alan Chouachi with the details.
According to the Supplementary Finance Law Report, the 2020 state budget in Tunisia was revised upwards by 9.4 billion dinars to reach 51.7 billion dinars, which is approximately $18.9 billion. The budget will be funded up to 58% by budget resources, while the remainder will be sourced from treasury resources. Authorities say that 99% of this amount will be borrowed. Tunisia expects a spike in the public debt volume to a staggering 90% of GDP, around $37 billion.
Downsize in the national economy. Our needs for financing are more important than what was expected. Actually, this is not something for Tunisia alone. If we look at the neighboring countries, if you look to Europe, if we look to Asia, we will see that whomever was expecting a growth in 2020 will unfortunately end up with a decrease in their GDP.
The World Bank said in a report released Monday that Tunisia's GDP is expected to contract by 9.2% in 2020, down from the initial forecast of -4% due to the COVID-19 pandemic. The Minister of Economy, Finance and Investment Support confirmed the latest projections.
Because of this pandemic, the economical situation of Tunisia has suffered. While we were thinking to have a growth, we will end up 2020 with a negative growth of around 8 point something. Maybe it will be close to 9.
Analysts assert that the current crisis, which has battered the tourism-dependent economy, has had direct repercussions on public finances in view of the top in the economic activity, leading to a decline in state resources.
Good governance is the first condition to improve the situation. The government can also borrow domestically to provide additional resources. The state resources are more limited since the outbreak of the pandemic. However, Tunisia has recorded an increase in state expenditures due to the difficult social, financial and tax measures taken.
The World Bank estimates that after the contraction in 2020, growth will accelerate to around 6% in 2021 before stabilizing to a more moderate pace of about 2% in 2022 as the effects of the pandemic fade away. Experts assert that the current social unrest and the political instability in Tunisia have a direct impact on the country's economic performance. In fact, policy uncertainty affects foreign direct investment as well as the business climate in the North African state. Adnan Shawishi, CGTN, Tunis.
Now, let's pull back for a wider perspective. The COVID-19 pandemic has not only jeopardized years of hard-won development gains in sub-Saharan Africa, it's also upended the lives and livelihoods of millions. The International Monetary Fund is forecasting that the region's economic output will grow by 3.1% in 2021. Now, that's a much smaller than expected expansion compared to the rest of the world. CGTN's Rachel Akufo spoke to the IMF's Africa Director on the lender's expectations for economies here in Africa in 2020.
We are projecting basically that this year the economy of sub-Saharan Africa will contract by around 3%. For a young, economy, relatively speaking, also, of course, with income levels being so much lower than the rest of the world, we typically tend to see sub-Saharan Africa growing faster than the rest of the world. And any kind of contraction really is bad news. And this contraction of 3% is by far the worst we've been able to see going back at least 50 years in our record books. So this really is a profoundly difficult year for the region's economy, and of course will translate into a significant increase in poverty levels, quite a lot of dislocation, people losing their jobs, people going without school, not putting enough food on their table. So overall, a very, very difficult year. What's striking really is also just how widespread the damage to the region is. really no country is being left unspared, both on the mainland, but also small island economies, tourism-dependent countries being heavily impacted, as well as, of course, the larger economies in the region. So really, this has been one of those crises where it's true around the world also, but in Africa, in sub-Saharan Africa, notably, very acute economic difficulty this year.
So is it clear yet then which African countries are in the best position to have a resilient post-pandemic economic recovery based on the direction that the continent was already going in before the pandemic?
Very good question. So, even in the midst of this pandemic, there are a few countries that will see some expansion in economic activity on account of projects that have been going on for some years and have been able to be sustained. Another, of course, bright spot is the fact that the number of COVID cases, the health aspect of this dual crisis that countries around the world have been facing, has been relatively attenuated, although I would add here that there is no scope for complacency. Even within the region, we've seen countries like South Africa being impacted really badly by the pandemic. So, and this still has a long way to go. So no scope for complacency, but it's reassuring that the number of cases has been lower on account of the strong measures countries took to shut down their borders, to clamp down on this disease. Now, looking ahead, we expect those countries that were on a reasonably strong growth path and have ample fiscal space to be able to rebound and continue to enjoy high growth. By the same token, this is cannot be taken for granted, and this pandemic really has changed many aspects of the global economy. So it will be important for countries to rethink their development strategies, to rethink about what the new sources of growth are going to be, and do the necessary policy changes, reforms to facilitate that. So we can't just expect a rebound and continued high growth.
And obviously, this isn't a recession in the traditional sense. This is a health crisis-fueled recession. Now, we know that the COVID pandemic is pressuring the resilience of the region's healthcare systems, while also forcing governments to have to balance that with cautiously reopening their economies so that they don't, sacrifice more jobs and more employment and have the small businesses suffer. What sort of policy mix or reforms do you think countries really should focus on to try and make that happen?
So, this is why I was cautioning, as I did earlier, that first and foremost, of course, the priority remains in the region very much on containing the pandemic, making sure that it doesn't get out of hand, and indeed, you drive it down as much as possible. So this health dimension remains very, very important. Associated with that, of course, is the need to make sure that people's livelihoods are protected, because, as you noted, a lot of the measures that countries have had to take to control the pandemic have had a bearing on people's livelihoods. And even if not impacted directly by the measures governments have taken, the fact that economic activity has slowed down, hotels have been shuttered, many other businesses are seeing less income, has also meant that unemployment and the like have gone up.
On to East Africa now. Authorities in Tanzania have announced plans to build a new 1,000-kilometer rail line in the southern end of the country. According to the country's Prime Minister, feasibility studies and the architectural and engineering designs for the construction of that line have been completed. Tanzania is currently constructing a standard gauge rail line from Dar es Salaam to Morogoro that covers about 300 kilometers. With the details, here's CGTN's Daniel Kijo.
The Tanzanian government says it is working hard to revolutionize the country's railway system. This was revealed by the Prime Minister Kassim Majaliwa at a public rally in Mtwara region this week. The Prime Minister said the construction of the railway line from Mtwara Port to Mchuchuma and the Liganga iron ore deposits is part of the ruling party's election manifesto for 2020 to 2025. Over the next 5 years, the ruling party, Chama cha Mapinduzi, says it will continue working to implement infrastructure projects, including railways, ports, marine and air transport, aimed at transforming the country's economy. Tanzania is currently constructing a standard gauge railway from Dar es Salaam to Morogoro, covering 300 kilometers. The $300 million Dar es Salaam-Isaka Railway is at the final stages as the government expands a broader Central Corridor transport network. About 44 wagons and 3 locomotives are expected to be ready by the end of this year and by the end of March 2021, respectively. The ambitious new railway project, all 970 kilometers of it, will be completed in 2 phases. The first phase from Dar es Salaam to Morogoro has already been completed, and the second phase, the 687 kilometers from Kilosa to Isaka, is still underway. Daniel Kijo, CGTN, Dar es Salaam.
It's 18:35 GMT. You're watching Global Business Africa. Time for a short break. Here's what's coming up. The United Kingdom has signed its post-Brexit trade deal with Japan. We'll have the details. And Chinese banks are reporting positive foreign exchange data amidst an economic bounce back after COVID-19.
This has taken me completely out of my depth, but at the same time it's exciting. It's new, it's different, it's a challenge.
It's really exciting.
Over the last 48 hours of rain.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
Accra is my kind of city. That's because when I'm here, I feel like I'm back home in Lagos or Abidjan, which are 2 of the major cities I grew up in.
Business in Africa is
After about a decade covering business news on the continent, I've learned it's all about the high risk, but also the high returns and the high energy. You simply have to adjust in order to keep pace. When I started out as a journalist, my dream was to open people's minds to the different perspectives. From the CEO in the boardroom to the trader out in the street, we all have different stories. From Accra to Addis Ababa, from Cairo to Cape Town, and I wouldn't have it any other way. Here at CGTN, we realize that Africa is on the move, and it's moving fast, but we're moving right along with it. I'm Ucheo Koronkwo, and I'm a business anchor and reporter at CGTN.
Welcome back to the program. These are some of the stories making your headlines at this hour. Let's start in Libya. Warring factions over there have signed a permanent ceasefire agreement that does mark a rather historic breakthrough towards reuniting the North African state. Now, the acting United Nations envoy to Libya, Stephanie Williams, says that truce starts immediately. She also says that under the agreement, all foreign fighters need to vacate the country within 90 days. Libya has been rocked by civil war ever since the ouster of the country's leader, Muammar Gaddafi, back in 2011. The US President Donald Trump has announced that Sudan will start to normalize ties with Israel. That makes Sudan the 3rd Arab state to do so as part of US brokered deals. The deal will deepen Sudan's engagement with the West as well. It comes in the wake of Mr. Trump's conditional agreement to remove the North African state from a list of state sponsors of terror if it pays some $335 million in compensation to American victims of the 1998 bomb attacks in Nairobi and Dar es Salaam, Tanzania. And the United Nations has raised nearly $1.7 billion in pledges to fund aid efforts to assist millions of people in Burkina Faso, Mali and Niger for the rest of 2020 and 2021. The UN aid chief Mark Lowcock has been warning of a looming but entirely preventable tragedy in the Central Sahel. That's a run through your headlines. Further afield, Japan and the United Kingdom have signed a trade agreement that essentially marks the UK's first major post-Brexit deal on trade. The Japan Foreign Minister Toshimitsu Motegi and the British Trade Minister Liz Truss signed that agreement in Tokyo. Now, the deal had widely been seen as one of the easiest for London to essentially nail down. It's based largely on the EU-Japan agreement, which covers the UK until the end of the year when the Brexit transition period comes to an end. Other negotiations, however, with the United States, especially with the United States rather, have progressed at a more glacial pace. The deal removes British tariffs on Japanese cars in stages all the way to zero in 2026, and that's essentially the same as in the Japan-EU trade agreement. Turning over to China now, there's more evidence of a growing recovery today. Authorities in Beijing released foreign exchange data for the first 9 months of the year. CGTN's Yo Yang has the details from that event.
Chinese authorities believe the country's economy is showing resilience after the COVID-19 pandemic, as its commercial banks witnessed a foreign exchange settlement of more than 10 trillion yuan or nearly $1.5 trillion, with a surplus of over 500 billion yuan or $76 billion.
China's economy has seen a stable recovery after the pandemic, leading the recovery of the global economy. This has greatly promoted the balance of international payments and the stability of the foreign exchange market.
But the country's forex reserves expanded to $3.1 trillion during the first 3 quarters of 2020. And this represents an increase of $34 billion compared to last year. Forex regulators explain why the RMB has recently appreciated.
The IMF predicts China will be the only major economy to achieve positive economic growth this year. The situation on exports is good, while long-term overseas funds have increased their holdings of RMB assets. And the RMB exchange rate has appreciated in the market, driven by demand.
Chinese authorities say next they will deepen reforms to the financial sector while adopting the much-anticipated dual circulation strategy to better service the development of the economy. Chinese authorities are also warning the companies to be aware of the currency risks, pay attention to the fluctuation of RMB's exchange rate, and do not engage in currency speculation. Yo Yang, CGTN, Beijing.
Onto the world of telecommunications. Huawei has seen its revenue for the first 9 months of the year grow by 9.9% year on year. Now, the figure was about 671.3 billion yuan. That's roughly $100.4 billion US. Analysts say the US sanctions on the company's chip supply plus the COVID-19 pandemic may have contributed to a slowdown in growth. Last year, Huawei registered double-digit revenue growth for the first 3 quarters, up 24.4% year on year. Net profit margin for the first 9 months of 2020, 8% compared to 8.7% over the same period in 2019. On Thursday, Huawei unveiled its latest flagship smartphone, the Mate 40. It is also, however, the first phone to include a chip made using a new manufacturing standard alongside the latest set of iPhones. It's the only other phone you can buy with a 5-nanometer processor. Speaking of the iPhone, the new iPhone 12 and the 12 Pro hit stores in China today, the 23rd of October, after the smartphones launched some 10 days ago. And clients were clearly excited. Many people are lining up outside Apple's Beijing flagship store this morning. Chilly weather, clearly not a problem. Now, the latest models come with much faster 5G connectivity and a significant upgrade in the photography suite as well, as Apple does. The iPhone 12 series will set you back anywhere between 5,500 yuan or roughly $800 US to nearly 12,000 yuan in China, depending on which one you're going for. The iPhone 12 mini and the Pro Max models will not be available for sale there until next month. Apple's 5G phones are a little late to the party compared to other handset makers, including China's Huawei and Xiaomi, but nonetheless, a new iPhone was certainly very much anticipated in China. On to the United Kingdom now. The country's Finance Minister, Rishi Sunak, has unveiled a range of measures to help workers and companies get through the winter as coronavirus cases rise. Now, if scaled up across the UK, this package will be worth more than $1 billion. But critics are arguing that not enough is being done for the hospitality sector. As CGTN's Juliet Mann now reports from London.
Hospitality has had a roasting. From local cafes to swankier joints, the pandemic made it hard to make ends meet in lockdown and out. Now, with restrictions tightening again across the UK, restaurateurs are left stewing.
We really need something akin to the original furlough scheme, but something that takes into account the trunk payments, that's the tips that hospitality employees earn. So something that's getting people up to 80% of their normal salary.
UK Finance Minister Rishi Sunak has announced new measures, including backdated cash grants for hospitality workers. It's the third major support announcement in less than a month, after he was slammed for not going far enough to help firms through the winter.
Support for people's jobs and incomes, all on top of over £200 billion of support since March. This is our plan. A plan for jobs, for businesses, for the regions, for the economy, for the country, a plan to support the British people.
And support is what they need. The latest survey of the UK economy found that nearly 1 in 5 hospitality firms see a severe risk of going bust. Another 21% are facing a moderate risk of collapse. And 7% have no cash reserves, leaving them very vulnerable. Stepping out of the kitchen, waiting staff, hoteliers, baristas, chefs and more are campaigning for the government to rethink the new pandemic restrictions and consider the long-term economic squeeze. Organisers say otherwise, 750,000 people could be out of a job in the next 4 months.
Things like the 10 p.m. curfew really don't seem to make any sense at all. The fact that a third rush hour has been created with all these people going out onto the streets who've been drinking all evening and possibly not in their normal state of mind just seems to be absolute madness.
Despite hospitality in the UK being an $170 billion industry responsible for more than 3 million jobs, there's no government minister for hospitality to represent the interests of these businesses. The sector argues that they need representation as well as a long-term support plan.
Now, a top issue that's on the minds of American voters every election year is the state of the economy. One major sector of the economy, that's leisure and hospitality, is hurting at the moment and hurting pretty badly. According to the National Restaurant Association, nearly 3 million US restaurant workers are still out of work as a result of the pandemic. CGTN's Hendrik Sibrandi looks at how those in the industry are faring.
Jake and Jovanina Linsenmeyer say there's nothing like a busy night in the restaurant business.
The music's right, and the crowd's right, and the food and the drink is right, and it creates a vibe with everybody.
We love a, 3-deep heaving bar and, shakers going in the background and people talking to each other.
The pandemic brought all that energy to a screeching halt in March when the Italian restaurant they own in Denver was forced to shut down.
It's awful. We can't do what we do. Everything that we love about our business has been taken away.
Stay-at-home orders followed by strict capacity limits and the reluctance of people to eat out when some restaurants did reopen have dealt a severe blow to the industry, which already operated on thin profit margins. Nearly 1 in 6 dining establishments in the U.S. have either closed permanently or long-term.
It's actually kind of makes you sad,
It's a really tough time for a lot of my friends and colleagues.
Tim Saipasong, an unemployed server, has taken a big financial hit.
At this point now, I'm dipping very hard into my reserves. I'm probably going to have to apply for even more government programs like probably food stamps.
Unemployment benefits and federal payments to restaurants and their employees helped cushion the blow earlier this year. But some say more stimulus relief is badly needed.
I think overall it'd be very safe to say the government has not done enough.
Sonia Riggs heads the Colorado Restaurant Association. Some of the 90,000 restaurant workers who've lost jobs in her state this year are benefiting from a relief fund her organization helped set up. But she estimates 2/3 of restaurants here will close by next spring if conditions don't change.
It's not only been a very, very tough 6 months, I'm quite concerned, as many others are, about what winter is going to look like for this industry.
She also worries that some people could leave the industry entirely.
I honestly don't really know what else to do. That has been my skill set for my entire adult life.
The owners of Giovannina's feel the same way. They're rolling the dice and planning to reopen with a focus on takeout and delivery in a few weeks.
We want to just get it back and going. Like I said, what that's ultimately going to look like, we're still juggling that a bit.
He says human nature will always be to be together, be social, and entertain.
Yeah, that's a big part of our industry in general, making sure that we're there for everybody's special moments and making sure that they go off without any hitches. So I'm hopeful for the industry.
Once it's safe, we hope it'll be normal.
It's getting to that point that for many restaurants will be the challenge. Hendrik Sabrandi, CGTN, Denver.
Back to the continent now. The South African President, Cyril Ramaphosa, recently announced a 3-year, $6.5 billion package aimed at boosting job creation in Africa's most industrialized economy. South Africa is still struggling to reduce its vastly high unemployment rate, which has been made even worse by the COVID-19 pandemic and the subsequent lockdown. Tonight on What's Hot, CGTN's Sumitra Naidu takes a look at how tech is helping many in South Africa improve their odds of getting employed.
Arnold Graaf from Johannesburg opened a coding college back in 2004. Having studied science and technology as a student, Graaf knew there was always going to be a need for IT skills and realized it was an opportunity to create employment.
We trained people in IT skills, mostly professional people. And then, we found that there's a need for juniors to come into the market. And they said, okay, let's train matriculants, because we know what the employers want.
With technology advancements occurring daily, companies need to ensure they stay ahead of the curve. But investing in new tech and innovation requires the correct skill.
We know they want skills. They're not so much concerned about academic qualifications. We trained the people and we created the boot camp, and that is what we focus on. We really want to get the guys employed. That is the main goal of Code College, employment.
They teach you basically everything you need to know from a workplace standard. So when you get into a job, you already know basically what you're going to do. They already teach that to you in the institution. And they also look for a job. After you complete the boot camp, I just got my first job. So yeah, they also help that.
Code College has a range of different coding boot camps for both young people and older professionals that need to be upskilled. Graaf believes the boot camps are more relevant for the workplace today than traditional academics.
When you train somebody, you have to give him a good, solid foundation that he can use for the rest of his life. There's a lot of rural schools that cannot afford an IT teacher. And so what we're doing is we partner with companies and NGOs to set up training centers. So the one training center can actually service 20 to 40 schools in the area.
So I kind of saw a rise in programming, and I thought it's the way to go. But the conventional way of going to varsity would take really long, and it's not really guaranteed. I work at ABSA, and I've been working for a little over 2 years now. I'd say it's a guaranteed success because companies all over South Africa and all over the world are looking for developers.
Can I see some identification, please? Thank you.
Code College enrolls up to 50 students per year, but is planning to double that next year. Sumitra Naidu, CGTN, Johannesburg, South Africa.
All right, then a quick run through commodity prices for you. We did speak about Zambia earlier in the hour. It's still Africa's second largest exporter of copper. And yes, it's in the middle of a bit of a debt crisis, so it's important to figure out exactly what the revenue side looks like. Copper prices at the London Metals Exchange up 1.4% so far in October at about $6,900 a tonne. Copper prices, in fact, are back to where they were in the first half of 2018. At $41.96 a barrel, it's around 1611 GMT. Brent is negative for the month. Remember, Libya's light sweet crude is coming back into the market in the weeks ahead. It will actually cross the 1 million barrels a day mark in output. So essentially, it's adding supplies at a time when arguably there's no match in demand. Here's what's coming up next. We'll take a look at a ride-sharing app that is helping Egyptians dodge heavy traffic. The details coming up shortly. Welcome back. Now, there does seem to be no limit when it comes to innovation in mobility solutions, particularly in Egypt, where new digital-based transport solutions are now coming to the market progressively. Tonight in Grassroots, CGTN's Ramah Nyang takes up the story of Rabbit. It's a ride-sharing app that's offering Egyptian solutions for short-distance travel while trying to cut greenhouse gas emissions.
Micromobility has taken cities across the world by storm. The concept seems to be the new big breakthrough in transportation solutions, and in Egypt, it's no different. Vying for a slice of Arab's most populous nation's market now is Rabbit, a clean tech micromobility company that's hoping to ease Cairo traffic congestion problems.
We are a company called Rabbit. We started the ride-sharing concept through electric vehicles people can use to get from one point to another over small distances. The vehicle we chose to launch with is this electric scooter. We found it to be an easy way for people to get around. It's fun, it's enjoyable and environmentally friendly. We used a concept that is available in other countries, which is the scan and go or the unlock and go. You use the mobile application to scan the code and then start your journey from point A to point B. And once you're done, you can lock the scooter and leave it.
Founded in 2019, Rabbit was created for quick, short-distance trips. The app is not just convenient, it's also an environmentally friendly alternative to cars. The way Rabbit works is that users are charged for renting the scooters, which are found in strategic locations. To rent this, users unlock scooters using a QR code from the service's application. After use, the scooters are dropped off at the nearest scooter station to one's destination.
The best thing about this scooter is that it allows you to get around and see parts of the city that you might have never seen before.
My movements inside New Gaza is usually between a supermarket, the club, the gym, the hairdresser, so this is very suitable for me because firstly, it's easy to park, it's small so allows me to move through any area, very easy to use and I'm really happy with it. It helps me run my errands quickly.
Competition in Egypt's ride-hailing and tech-enabled transport market has been heating up for years. Rivals from global giant Uber to smaller local firms are currently battling out in the North African nation. And as with most Egyptian startups, the goal for Rabbit is to expand to the Middle East and across Africa in the near future. Mahemutwa, CGTN.
All right, then a brief run through the currencies. Kenya's currency, the Kenyan shilling, seems to have settled around the 108, mid-108 level, at least on the interbank market for the time being. The local unit has depreciated by at least 7.5% so far in the year. One key development of note there, the country's pensions regulator has allowed pension funds in the country to take part in securities lending and borrowing, subject to approval from trustees, and that will only cover stocks within the NSE 20 index. We'll see how that does play out. Pilot programs, of course, have been in place for the second half of the year. That's it for this edition of Global Business Africa. As always, we'd like to hear your thoughts on the content you've seen on the program in the last hour. There are many ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The World Today is up next from Washington, D.C.